Welcome to the Property Buyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to our next edition of the Property Buyer Podcast. It's that time of year again, almost the end of the financial year, when everyone has to pay more attention to the amount of tax they're paying on their pay slips, and the advertisers go mad promoting end-of-year financial deals. It's one of two absolute certainties in life, death and taxes. But while you've got the rest of your life ahead of you, how can you make smarter and more tax-effective decisions about your personal situation? Are there legitimate and legal ways to reduce your tax by using smart strategies or structures that could also protect your assets? If you're paying 45 cents in the dollar, then effectively you're working for the government from Monday to Wednesday lunchtime. So to help our engaged listeners to get better insights into tax-effective property strategies, I'm privileged today to have Jay Gounder, Director and Chartered Accountant from Agilis Accountants. Great to have you on the podcast today, Jay.
Thank you, Rich. Thank you for inviting me to talk about these important matters.
It's a pleasure. Jay, we have a little tradition on our podcast, and I'm going to throw you a quote of the week, which is from Ralph Waldo Emerson. And he says that the only person you are destined to become is the person you decide to be. What do you take from that quote, Jay?
I really like the quote, and one of the things I say to my staff and people I associate with is to be a difference maker in the world. One can take small steps to create a better life and environment for those around them.
Excellent. Yeah, I think it's sort of making, for me, it's that quote is all about just what you decide, you become. What you think about, you become, a bit like Yoda says, there is no try. You've got to be definitive in your own mind about what you want to achieve and the kind of person you become along the way. It's very much about your character. So I really love that quote. So Jay, that's enough philosophizing, if you like. Let's get stuck into some questions. And I've got a bunch today, so I hope you're ready. All right.
I'm looking forward to it. Yeah.
Excellent. Well, look, first question. Are you an active property investor yourself? And tell me a little bit about your backstory. What motivated you to get started into property investing?
That's a great question, Rich. I first got onto property when I was 17 and a half years of age.
Wow.
My story was I finished high school in Fiji and moved to New Zealand. And Mum and I bought our first property together in New Zealand, and it was a unit in a place called in a little area of Auckland, and we really had our first house that I could go to university from there on. So yes, I would say that I have been investing in property to ensure that I carried on that ladder for a number of years.
Fantastic.
Now I actually consider property as one of the wealth creation strategies for retirement.
What was the thing that kind of really sparked your interest in it? What sort of motivated you to kick off with investing?
I saw growth in property and also the forced savings. Forced savings creates a little bit of a discipline. So that was one of the reasons why I thought property was the way to go, because you just can't sell a bedroom out of a house and cash up. So you have to make some very considered decision-making processes.
Excellent. Yeah, I really like that bit about you say forced savings, because I think it's a really great financial discipline to have a property. I think someone once says that if you don't spend your money on property, you'll spend it on something else. And I think it's a great thing to have, to be paying a mortgage and watching the capital growth and the equity of that investment grow, particularly over time. I've found for myself that once you've held a property for at least one cycle, in other words, at least 10 years, the growth starts to get much more exponential. And as you well add multiple properties to your portfolio, it's just fabulous after 15 years. But tell me, Jay, do you have a particular style or a particular strategy when it comes to property investing yourself, or even what you've seen your clients using? Can you tell us about some styles or strategies that you've seen that have been effective?
I think what has worked effectively for a lot of people are the basics of property investments, which are close to public transports, close to schools, and close to shopping centres. It creates an environment or a lifestyle option for tenants, for people to buy and live in themselves, and also being close to those transportation and schools. It gives them opportunities to create more long-term investment income streams.
Okay. Yeah, great. Excellent. What about any other types of strategies you've seen people use that you've seen have been effective before? Do people sort of go with negative gearing, positive cash flow, renovations, like those kind of broader strategies? What have you seen people start with and then perhaps evolve over time?
I see them buying older houses and then demolishing it, and if they've got the equity built up over a period of time, they build brand new houses and rent it out and create their own negative gearing on paper, but it becomes positive cash flow over a period of time. So they tend to claim as much of the deductions over that period of time. Also, I have noted that they utilize land pretty much to build ready flats in the back of it to create dual income streams. So that's been quite effective for a lot of people over the years, in my experience.
Yeah, look, I certainly love the renovation strategy myself, and I love the knockdown rebuild strategy. I've done that a couple of times myself, and particularly the granny flat strategy. That's very popular. And the laws, I'm doing a webinar next week actually on that very topic, and the laws in every state differ. So in New South Wales, you can build a granny flat pretty much anywhere, as long as you've got a big enough land size and the setbacks. Obviously in Queensland, it's very council dependent. And in Victoria, they've just changed the laws, so you can actually now do it in most places like New South Wales. But as you say, getting that secondary income, it really does boost the yield, doesn't it? I mean, it takes something from a 4% yield to potentially a 6+% yield.
And I think that's what a lot of people are looking forward to, is the income stream and income yields to ensure that they've got a lot of those things covered.
Yeah, okay. Tell me, I get asked this question all the time, and I suppose you do as an accountant, but in terms of structures, right? People say, what structure should I buy a property in? Should I buy it in my personal name, in a company name, or a trust? How do you decide, or how do you advise what name or entity to purchase an investment property in?
That's a great question, and it's very timely given that a lot of the state governments like Victoria and New South Wales are changing laws around trust ownerships and how they tax different things. We, as a firm, go through a detailed process of looking at personal circumstances of individuals and also their future plans with property or future plans with businesses, and do a risk analysis and then come up with some options. The options invariably could be individuals as trustees or trust ownerships rather than direct company ownerships. Companies don't tend to get any capital gains tax discounts, whereas trusts and individuals do get those discounts. And a few times we've had to use the corporate trustees with trusts to have the ownership for good reason and for asset protection reasons. But we have to weigh up the bank's assessments of these things. So there are three types of ownership structures used in Australia. People buy it in their personal names. They either buy it in a company or they buy it in trusts. And we have to get the right mix to ensure we are under the land tax limits in different states. We ensure that it has appropriate structures in place for debt optimization to pay off the loans, and also consider the impact of capital gains tax down the track.
Yeah, look, there's some really good thoughts in what you've just said there. I think a lot of people don't necessarily think about asset protection. They just think, I'll just put everything in my personal name. But is there particular types of occupations that you would suggest that would lend itself more for people to put their properties into a trust for asset protection reasons?
Certainly. They're mostly high income earners or they are professional services personnel, because they are likely to be going through the exposure of the risk of banks or risks from potential third parties or suppliers to be sued. So it's one of the reasons why we actually look at that and go, these are the reasons why I would highly recommend a trust strategy, and they actually understand the risk versus paying a bit of premium on land tax and having that peace of mind for the future.
Yep, exactly. Yeah, I mean, I think there's a lot of flexibility. I know in my own situation, I do a combination of personal name and corporate trustee as trustee for a trust. But the disadvantage, obviously, is you lose some of the land tax threshold. And we'll talk about that more in a minute. But I think it's really important for listeners to understand that trying to do this on your own is a fatal mistake. I think it's very important to get considered advice from an accountant like yourself, Jay, to help someone, plan out the future, plan out the acquisitions and get advice. And it might be that as someone's career evolves, that they might think about different structures and different times of their lives. Wouldn't that be right?
That'll be a correct assumption as well, Rich. But also adding to the fact that when we work with a company like yourself on the details of what the land can do, so if there are development potentials and splitting blocks and other things, we talk to professionals like yourself and come up with the most tax efficient structures, and also avoid paying double stamp duties and paying lots of different things, because we've got to actually plan out what the future of that land value does and what the future of the investors' potentials are, rather than just looking at it right now. Let's finalize the deal and get it over and done with, because you can't go into contract without considering these options.
Well, it kind of comes to my next question, and that's what's the implications of buying an investment property in the wrong entity? In other words, what happens if you put it in the wrong name? And I think you've kind of alluded to it, but you mentioned paying double stamp duty. You realise, gosh, I put it in the wrong entity. I've got to transfer it, but that triggers a land transfer, right? But what are the other implications of buying in the wrong entity down the track?
There are some massive repercussions for GST or capital gains tax. So I think our governments don't miss us on the 3 tiers of hitting us with taxes to fund the great country, obviously. So there are options that has to be considered around what the capital gains tax ramifications could be. The other would be stamp duty from state governments, and the third would be the councils would be rubbing their hands to get different sets of council rates and fees and charges and development costs. So there are massive implications across the board to getting it right in the first instance.
Excellent. Yeah. Well, I think it's just for the sake of a simple consultation with yourself, I think it's certainly important to get the right structures set up. Talking about people on high incomes, like people like doctors and medical specialists and neurosurgeons, whatever, or lawyers or finance professionals that are on pretty decent high incomes, they typically use negative gearing as a strategy. What do you think about that as a long-term strategy for those kind of professionals? Do you think that works?
I certainly I think they should consider some professional advice rather than just go down the negative gearing path, because they still have to fund it from cash flow. But I prefer that they consider those things from a long-term perspective. It has really worked well with some of our high-earning clients over the years. And surprisingly, there are a lot of tradespeople like builders who fall in that category as well. And a lot of fly-in, fly-out mining workers as well, they tend to be quite savvy with their investments, and they understand that they're paying top marginal tax rates for income that they're earning, and they do this well. They claim the depreciation deductions, and it's not costing them as much out of pocket. I sometimes talk to tradies with the beer currency. I'd just say, hey, it'll cost you 2 cases of beer to keep this property a week, and they'll go, okay, yeah, Jay, I can afford that, or not, and I think they love that type of translation.
We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast. I think the thing I would say about negative gearing, Jay, is that you've got to be careful about how long it's going to be negative, because, you know, you think about a doctor and they're not going to be a doctor for perhaps the rest of their life. You know, if they're a doctor at age 65 and they're sort of then retiring, you don't want to have 10 years of negative cash flow on a property. So I think if you're buying a negative gear property, definitely it's can be a strategy that works for a period of time, but eventually as rents rise and as you pay down the loan, you want that negative gearing to then become neutral gearing, to then become positive gearing. Because if you just have every property in your portfolio as negative geared, you'll quickly run out of serviceability and come to a grinding halt when it tries to buy more property. So I think it's really important that people plan out their futures and buy high growth properties that are negative geared for a period of time, but then balance it out with other positive cash flow properties. Would you agree?
Absolutely. It's free cash flows that end up making them grow the equity to go into the next project and the next project. And I believe that a negative gearing for the sake of it, you've got to spend $1 to get 49 cents back. I don't think that's that's a good way of putting it. But they have to understand free cash flows. They have to understand why when they talk about negative gearing, it shouldn't cost them hundreds of thousands of dollars, because they'll have growth only in the future. So don't buy on potential only, but have a considered approach to why you're investing in their property.
Excellent. Jay, I want to ask you about self-managed super funds. What are the, I guess, key advantages or disadvantages of buying property investments using your SMFS?
So one of the things that the government did introduce back in 2011 was borrowing strategies with SMSFs prior to 2011. But we saw a huge growth in that sector. It also was a bit complicated because a lot of the super funds were designed to only be utilized for retirement purposes, the sole benefit of an individual in retirement. And a lot of people went down the path of buying holiday homes and other things, not realizing that the rules were quite strict around that.
Yeah.
So what has happened in the last few years is a lot of the major banks have are not lending to it, but I still consider that it is a good strategy if you've got some high growth properties and you have got investments in superannuation that can grow in quite substantial market value. It is not that difficult to structure it in such a way that self-managed super fund is another investment strategy, as long as you don't consider it to be your holiday home or you're purely doing it for investment purposes. And there are lenders out there who can lend against the self-managed super fund properties. And a lot of people in Australia have got quite a substantial amount of money in super, and they'd like to gear them and actually make more money out of it. So it is really about understanding the cash flows, really understanding if they're going to go into retirement, and that property will be subject to no capital gains tax if it meets all those other provisions of their assets being under 3.2 million for 2 member funds. or 1.7 million per person. So SMSFs are a great strategy for someone nearing retirement, but I would be very cautious as to the costs as well, because it can be expensive to set up, and it'll be very expensive to unravel if it's not done right.
Okay. Just quickly, what would it cost to set one up, roughly?
The price range for setup of SMSFs range from $2,000 to $5,000, because you'll have to engage with a financial planner to get some advice, and the ASIC is cracking down on advisors who decide to get self-managed super fund set up without getting appropriate advice.
Yes. Yep. Okay. I think one of the other, I guess, benefits you've sort of alluded to it is the capital gains discounts. So when you're in pension phase, I understand there's no capital gains tax. Is that correct?
That's right. As long as you meet the conditions, and the government's talking about properties that are geared will be considered as part of a whole asset strategy. So we're sitting on the fence at the moment, not knowing what the government decides to do with that, but it's not going to impact a lot of people, because if you're buying $1 million property and you've got $2 million in super, all in all, and you hit retirement strategy, you will have quite a significant tax-free component of your property. So it's a really good strategy that a lot of people utilize.
I think everyone should have at least one property in their super fund, but that's just me. That's not financial advice, by the way, but that's just me. But tell me also just quickly about the caps. The Labor government recently introduced the $3 million cap. So if you've got a husband and wife that have got a self-managed super fund, does that mean the cap is $6 million as a total cap?
The cap isn't on the amount of investments you can have. The caps are around per person. If it's $1.8 million of balances in super, you can't contribute more non-concessional amounts. You breach your rules there. There are some caps around. There's no limitations on growth items that are already in there. So what happens with a lot of self-managed super fund properties and assets is if it reaches above that amount, it gets taxed at a 15% rate in pension, and it's 30% in accumulation accounts. So it's to avoid creating a tax haven in a self-managed super fund environment. So.
Okay, excellent. All right, let's move on to land tax. Now, land tax is not a favourite topic of many investors, but it's one of those things you just have to live with, right? How can investors really minimise their land tax exposure? And I guess how much of a consideration is this when selecting a location where to invest?
Land tax by very nature would be applicable if you are land banking or buying lots of real estate with large land portfolio. But in Brisbane, we've seen some significant growth in properties, and land values have doubled or in some cases has tripled in value in the last 10 years. It is the government's way of saying we'll try and raise money. To best structure it, we have to ensure that people have got their land tax limits maximized in their personal names, and anything that they buy on top of that, you've got to do a cash flow around what the costs are going to be. For example, if the land tax threshold in Queensland is 1.32 million for a couple, so they should be maximizing that on top of the principal place of residence exemption. So your principal place of residence is exempted from land taxes in most states. So the idea would be to have ownership in such a way, and you can become an individual trustee of a trust. You don't have to be a corporate trustee. So individual trustees can apply their land tax thresholds in Queensland towards their ownership. But there's other considerations to make. If you want to negatively gear, if you have it in a trust, you can't. Your losses are quarantined. So land tax is one consideration, but also we have to consider other aspects of it. Residential properties generally mean that landlords have to pay the land tax. In commercial properties, however, the tenants, in most cases, the tenants have got those outgoings considered as part of the land tax calculations.
Okay, excellent. Yeah. One of the things that we suggest to our clients is obviously, again, talk to an accountant to get that accounting advice, but also just diversifying across different states, I think is really important as well. Making sure that you're looking not just at buying all your properties in one area, but taking advantage of the land tax thresholds across multiple states, because as you say, each state has a different threshold, and it's good to get exposure across different property markets and different growth markets, and take advantage of that.
Yeah, certainly. It's and also using your services if people don't have time to go and research what's happening in New South Wales or Victoria, and getting the right advice is critical, because you can really be exposed in different markets unless you have expert advice in that.
Jay, you kind of touched on this one, but I want to ask you again just about specific investment criteria. When recommending a strategy, is there any other kind of specific investment criteria you recommend? So you've talked about buying close to shops, schools and transport. In terms of a strategy, looking at the cash flow, is there anything else you sort of wanted to add to that around specific investment criteria?
I look at certain things when I'm talking to people, but I also ask them to get some research on different areas like growth and future developments, or one of the key things is to see that growth generally is within the inner radius if you have the affordability to do so. And the inner radius of most major cities in the world, there's only limits of how much land they've got available there. So I think land is the scarce resource. You can't continue to manufacture it, and that's the beauty of using research houses like yourself to go, okay, which pockets are good and which pockets are really, really solid for investment growth, and making decisions based on that, rather than saying, oh, well, I want to live in that area, because sometimes living versus investing are two different things from a cash flow and your investment strategy for the future.
You've touched on a really good point there, and that is to leave emotion at the door, right? When you're buying investment property, I say to my clients, essentially, you're buying a bunch of bricks that's going to make you money, right? I try to dumb it right down. And I say, don't worry about the colour of the carpet. Don't worry about the colour of the paint on the wall. Don't worry if a tile is chipped. They're little insignificant things. I mean, people get hung up about the colour of the doorknobs, the shape of the architraves. And I mean, they are considerations, don't get me wrong. But you've touched on the land supply is one of the most critical things in deciding the propensity for growth. I mean, being an economist myself, I look at everything through the filter of supply and demand. What is the demand for owner-occupiers? What is the demand for property in this area? What is the demand for rentals in this area? And then what is the supply of rental properties? What is the supply of owner-occupied properties? How long does it take to sell a property? What are the days on market? What are the vendor discounting? All of those numerical, factors we look at. But God's not making any more land anytime soon. So, buying into an area that's got constriction on land supply, in my mind, and that has great lifestyle appeal also is important. But those sort of factors of supply versus demand is very critical in choosing a location. And all of the property individual features and the look and feel of the property come as a very much a second or third priority down the track. But I think it's important just to sort of round this discussion out around strategies. I think it's really important listeners think about what strategy will work for their personal financial situation. So I think we sort of touched on the high income earners looking at negative gearing. I think also we've got to look at the other end of the scale, people on more limited incomes, like a 70, 80, 100 grand type income. What sort of strategies could they use? And I'm thinking, it's got to be a positive cash flow type strategy, right? Where they've got to go for something that's not going to affect, their day-to-day living expenses, right? What do you say to that, Jay?
Yes, certainly. I mean, if they can buy and have investment strategies, and that, we coach it to our staff members here, is to ensure that they have allocation of right amounts of money. They're not buying something that needs a lot of renovation and a lot of repairs and buy something off the plan, get a solid tenant in. They're happy to pay the rent, and you've got a good negative gearing happening against your income and depreciation, and it's not costing you a lot in terms of negative cash flows, but it can be done in such a way that you can afford it and be able to have a capital growth position out of their property in a few years' time. So they tend to appreciate that advice, because I think a lot of the accountants leave a lot of emotions out of this, but when they're buying properties, they have a lot of emotions because they are the decision makers in their group. They talk about that, but the fundamentals are the same. If you look at the growth corridors in Queensland, with immigration growing at the rate of double digits, we have limitations on how much people can afford, and there are not going to be a lot of people who will be able to buy property without having to save up. So you become part of the government's strategy of becoming social housing suppliers.
That's what we'll do. Exactly. Yeah. We all know that private investors are a much better way to supply the housing market than the government. They're too slow. But, and the other thing too, just about affordable investment property. We did a webinar a couple of months ago, Terry Ryder, talking about where to buy under 500K. And we had a record number of people watching that webinar. And we talked about areas, like Mackay or Townsville, for example, and we're regularly buying in those locations. In fact, we just bought for a client there yesterday. We're getting a property around 500K and getting a 6% yield. And that's great for someone who, has only got a limited budget, and they're going to get capital growth, but more importantly, they're going to get really strong cash flow. And that's going to help them to then, be able to afford to buy back into a capital city and that sort of thing down the track.
And Richard, also adding to that, we've recently gone through the process of merging a firm out of Cairns, and we see so much opportunities up north in Cairns as well, with warmer climate and the potentials up there with the employment in tourism, and when the borders have opened, it shows the opportunity for people to invest in different areas. But I'm not sure what your thoughts are around Cairns and North Queensland.
Yeah, look, I think Cairns can be okay. I prefer Townsville. It's got like 5 pillars to its economy. Not as tourism reliant. So I'd prefer, if I had 500K to spend and I had to say, you said, Rich, do you prefer Cairns or Townsville? I'd be going Townsville every day of the week. But there's definitely opportunities in the Cairns market as well. But we look at all of the data and look at the history of capital growth. We look at all the suburbs that you can buy in. And even within Townsville, there's certain suburbs we don't buy in for various reasons. So it's very important as a savvy investor to make sure you get enough research before you go into a location.
Thank you.
Yeah. Jay, I just want to ask you, a thing that gets confused a lot of the time is repairs versus improvements. So tell us about tax deductions on repairs versus improvements and why investors get these mixed up. So immediate tax write-off versus longer term deduction. How does it work?
Yes, it's a very, very good discussion point at the end of the financial year when people come and see us. So we always have a explanation around this and how the ATO has written certain rules. Repairs is something that you have to repair, like if a sink is broken and you had to repair the sink or taps, they're repairs. But if you replace the entire kitchen, they're more of a capital improvement to the property. So if the argument from a investor is, I had to replace the entire thing because it's costing us too much money to keep maintaining it. We also have to say, well, the tax rules are pretty clear on these things. So we don't want to push the envelope with the tax office. There are certain rules around claiming deductions. But there's also a $300 write-off rule that's built into items under $300. So you try and break down as many items, and you have dual ownerships. So if a dishwasher costs you $595, you can split it between the ownership percentages.
Yeah,
so that's where a really smart accountant can actually go through and look at those and get the deductions for you. And if you're doing improvements before June 30th to a property because it needs to be done, otherwise the tenants are going to be upset about those basics not being looked after. You just have to pick up the phone and talk to the accountant about what can be claimed.
Got it. Okay.
And as you said, most people are advised by people to just go and fix it. Fixing items are repairs, improving it and making it more valuable will definitely go down the capital deduction. So you can get depreciation reports done and then claim it over a period of time. So
Yep. And so if you're replacing a kitchen or a bathroom, it's not just it's depreciated at X dollars. It depends on the items, and that's where you'd say it's better to get a depreciation schedule done, right?
that's correct. So if a sink costs $300 or $500, the depreciation specialist can use great tools to come up with better ways of doing it. And that's what the tax office is relying on, because accountants are not builders. They have no idea how much items cost and what the total items are. So.
Perfect. Excellent. Also, there's another question around the confusion around deduction for visiting an interstate investment property. It used to be you could fly to the Gold Coast and check on your property or fly to Cairns. So can you still do that, or is that been taken away from investors now?
Unfortunately, that's been taken away for investors. But if any of your listeners are needing an accountant in Brisbane, they may well fly to Brisbane, and that accounting visit is tax deductible. So the visit to the property may not be. So
that's a good little loophole. I like that. So Jay, when I come to visit you to talk about my Brisbane investment properties next time, I can claim that trip, the airfares and the accommodation as a tax deduction, can I?
That's correct, because you're traveling to visit your accountant and getting some of those things done from a strategic perspective, therefore deductible.
Okay. So what if people have 3 accountants? They've got one in Sydney, one in Melbourne, one in Brisbane. No, joking. Excellent. No, that's. I
think the costs would outweigh the benefit.
That's right. No, it's all good. But that's a really good thing to know. That's great. Jay, I want to talk about timing the market. We've got a lot of investors, especially at the moment when interest rates are high, that are what I call fence sitters. They're thinking that by waiting for interest rates to decline, that they're being smart. But as we know, there's quite a severe shortage of property right across Australia. And we're seeing really strong price growth in areas like Perth, Adelaide, Brisbane, for example. Would you say it makes more sense from an accounting perspective, just simply accounting, to buy now, cop the high interest rates, which we know are tax deductible, and if you've got the ability to buy an investment property, buy it now, rather than waiting 6 or 12 months for interest rates to drop 1%? What's your thoughts around that?
Yeah, I certainly agree with the philosophy that if you can afford it, and doing it now would be better than doing it in the future when everyone's saying, oh, we'll jump in all at the same time and miss out on it. And a lot of savvy property investors don't wait for the right timing. It's time in the market versus timing. And the fundamentals are so important right now that the cost of construction is going up higher. And if you can buy something and you're getting value, you'd rather just make that move now. And in our opinion, it's the time in the market that makes a lot of difference, because those cycles can be. We've seen some areas that have got 8% or 9% growth a year in Brisbane, and people have wasted their time in the last 24 months saying, "Oh, I'll wait for the interest rates to go down." So. It's never worked well for anybody when they expect that.
That's it. I mean, let's say that you buy a property in Brisbane. I mean, Brisbane's median price is almost $1 million today, right? $1 million, right? And predictions are the Brisbane market's going to go up 10% over the next 12 months. So that's $100,000 in capital gains. So pretty simple equation is, if I buy now, I'm going to be paying an extra 1% interest rate. Right. Well, what's 1% on $1 million? It's like 10 grand, right? Versus missing out on $100 grand worth of capital gains. So it's a pretty simple equation in my mind that if you've got the ability to borrow money, why wouldn't you go in and start buying now rather than waiting? Because it's otherwise investors end up chasing their tail. And then the other thing that's going to happen, I reckon, is that once we start seeing interest rates drop, there'll be 1 or 2 or 3, you're going to see the market re-accelerate, all underpinned by a massive shortage of properties. But don't get me on my hobby horse, mate. That's a discussion for another day around
But also the latest Labor government and Liberal Party pledges for whoever wins the state elections is looking at cutting the first-time buyers stamp duty and all those things that will further infuriate the market. So
yeah, exactly.
So when we've seen this in Brisbane so many times, when one market increases, which is probably the first-time buyers market up to $1 million, then the other markets start to quickly turn as well. So
that's right.
I think that's what people have to consider with growth and the Olympic Games in Brisbane and the whole of Queensland.
That's it.
And these are conditions that will make things very, very interesting. Interest rates play a little part to this whole conversation because people still have to live somewhere.
That's it. People always got to live somewhere. Jay, being an accountant, you probably get asked to share a lot of tax tips. Are there any other kind of key tax tips you would share with investors at this time of year?
I'll definitely ask investors to reconsider getting their 2-to-1D variations if they're actually spending a lot of their own money from their pocket. A 2-to-1D is a pay-as-you-go variation.
Isn't it Section 1515 now? Didn't they change it?
That's right. That's the one.
There you go.
And that is such an important part in the current climate because a lot of the rent doesn't cover the repayments on both principal and interest.
Yeah.
So it's a good time of the year to sit down with the accountants or actually email them with your request and talk to them about potential deductions. And because interest rates in the last 3 or 4 years had seen a very favorable rate to the investors, those things have changed in the last 2 years, and we're seeing a lot of our clients making those changes, getting more cash on their pay slips, and that allows them to keep paying the mortgage invariably in a way that they're not feeling the cash flow issues. So that's one of the tips. The other is getting tax depreciation reports, engaging with them, getting the depreciation reports on properties where they might have done improvements or they haven't been claiming all those things. And the last one is asking your agents, your real estate agents, to pay all the outgoings. So when you come to do accounting for it at the end of the year, you're not constantly chasing up different receipts from different areas. So council rates, your water rates are all centralized from one area, and then it makes sure that you've got all your all the paperwork and ducks in a row, and using one bank, a single bank account for a particular property rather than mixing it all up with different accounts and then not being able to track it.
Excellent. Great advice there. Thank you so much. That's excellent. And I guess, are there any other key mistakes that you see property investors make this time of year?
They do make certain mistakes. One is that they get in and try and sell properties. They go by settlement dates rather than contract dates. It's clearly written in case law that people have capital gains issues on the date of contract. So we always advise clients to be aware of that as one of the things and not get blindsided by the tax office saying, well, this was assessed on this date. The other is application of the 6-year exemption rules. A lot of people think that they're exempted from capital gains tax because they lived in that property and they sold it within the 6 years. So we explain that that's a myth as well. There are certain rules around that. If you've owned another property as a principal place of residence in that time period, that discount doesn't apply. So the ATO has got data matching facilities and now auditing a lot of people who've claimed the wrong exemptions. So they can easily track those things in that way. But that's only when a capital gains event has happened.
Yes.
I see a lot of property investors are very astute in Australia. They understand what things they can claim and what they can't claim. But they should also consider getting the right advice. If a property isn't doing the right thing for them, they should be offloading that and buying in areas where they will get better returns.
Yep, fantastic.
Like holding on to something that will never grow versus making a smart strategic move about what they need to do with it.
Excellent. Jay, I've got a couple more questions for you before I let you go. If you had $1 million in equity today, what would you do with it? How would you invest it in today's market?
I'll put it on the Broncos to beat opposition.
Yeah.
It's the Queensland Maroons to beat New South Wales.
They always smash them, mate. It's always a fait accompli. It's a bit of a sad state of affairs, anyway.
No, I definitely would be looking at talking to a property strategist about the best way to maximize my wealth platform, getting my advisors to prepare a high-level borrowing and tax strategy, and that's what I call the 80-20 rule, 20% strategy and 80% execution. So then executing with the right advice, a plan to purchase property in the right areas. I would probably use the advice you've given me today as well. Taking something out of the meeting today was buying interstate. I think being quite heavily involved with one state, you miss out on growth in other states pretty much. So
yeah, I mean, we're talking a lot about Melbourne at the moment. It's been unbelievably slow growth over the last couple of years, and it hasn't helped with the government slightly increasing land tax. So a lot of investors are exiting that market, but we're equally seeing some really good opportunities for investors that are going to hold for a 10-year cycle to buy quite well. Because we think Melbourne has got a lot of old money in it. It will certainly take off. But again, that's a topic for another day. So, yeah. Another question, are there any other higher yield strategies that you've seen smart investors use to get positive cash flow returns?
I always find that astute investors normally put in a grey flat to get dual income strategies from the property. They also sometimes use what I call pooling resources. So they might actually go into a partnership with a developer and then do developments on the property and get the maximum value out of the land with the old knockdown house. And I also see the high yield strategy that a lot of clients do use is just shopping around for the best ways to maximize their land yield. Like they would look at how much height can I get on a property there, talking to good town planners. So they do that, but from a positive cash flow returns on a property, they tend to buy in areas where there's a big demand for houses. That's how we've seen a lot of our clients have reinvested their monies to put another bedroom in or added something else and made it from a 3-bedroom to a 4-bedroom plus a study option close to the city. So they use some very simple strategies to maximize growth from their investments.
Excellent. No, great advice. Well, Jay, it's been a delight talking to you. One last question. Is there any fantastic piece of investment advice that you've received once in your life that you'd like to pass on to our listeners?
I'm still waiting for that advice, Rich.
You're still waiting for the guru to appear.
Well, someone wise once told me, you never change a good lawyer, your accountant, because keep changing them, you have to reiterate what your goals and plans are. So there's a pitch for the accountants and the lawyers in the room that once you form a relationship with a client, if you look after them, and the clients are being looked after, you become their investment advisors throughout on the best ways of structuring it and best ways to maximizing growth. So that's the piece of advice that I've received over a number of years.
Excellent. I'd say one is that a mistake that I see some investors make is they keep chopping and changing strategies, thinking that one strategy is going to be much, much better than another. And I think the takeaway from today should be that before you jump into any strategy, sit down, plan out and map out what you're thinking of doing, get some advice, and then execute. And I think don't go it alone. It would be another key thing. And buying property early, as we talked about, is a great financial discipline that'll set you up well in the future. So, Jay, it's been a delight talking to you. I know you're a font of wisdom. Thank you so much for sharing with our audience. We really appreciate it.
Thank you, Rich. I appreciate being invited, and go the Mighty Maroons.
We'll see how that goes. Well, thanks again, Jay. Thank you, our listeners, for another edition of the Property Buyer Podcast. We look forward to engaging. Thanks for being with us on another Property Buyer Podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.